Today we get way outside my depth. But what I keep hearing in all of this noise is we're right at the precipice of another huge financial crisis. Welcome to the Between the Lies podcast, your weekly lesson on how to approach an uncertain world with positivity and balance. I'm Nicky P, here with my good friends and money brains, Luke Tatum and Rob Brayton from Perfect Spiral Capital. Stick around till the end of the video for their free toolkit, and be sure to like and subscribe if you enjoy the video. Gentlemen, are these NDFIs the canary in the coal mine for something much worse than 2008?
Gosh, Rob, I'm going to let you give us the quick overview on this one, but I think the NDFI thing is a big deal. We just need to start with defining what that is, and it's going to be a technical episode, but I think we can do it.
Yeah, we'll try to keep it high level so it's not overly complex. Um, it's certainly not as complex as some of the stuff that we saw in 2008, but not non-depository financial institution. That's what NDFI stands for, and these are uh, companies that are somewhat standalone that are they don't require deposits in order to lend money. And that's essentially the simplest way to put it is that there's a way for private capital or capital from banks to be implemented into the monetary system in a way that allows for potentially higher profit margins. And that's really the basis of what these NDFIs are for and how they're structured. Now, I think it's really important to understand that we don't want people to think right off the bat like if a company's an NDFI, it's automatically bad. That's certainly not the case. There are some actually very big household names that are technically NDFIs. Visa is one of them, PayPal. These are some of the larger type institutions. What we're talking about is there is a sort of a subset of NDFIs that operate within a more, should we say, risky space. And these would be like car loans, finance companies. They could be subprime mortgage lenders. They could be uh, lenders that are investing in commercial real estate or even in residential real estate that maybe is a little bit more risky, so to speak. And the thing is, and why this is a potential challenge, is you have a pretty significant amount of capital that's being invested into these companies that doesn't necessarily have to be disclosed in the same way that it does within the banking institutions. Now, I think we're all well aware on this podcast. Does that really matter all that much? In terms of governmental oversight, not really, but it is an interesting space within the financial services realm that isn't really talked about, but is a concern because we've seen there was some news this last week that some of these NDFIs had actually started to have a lot of bad loans, and some of these companies that had been loaning to NDFIs are writing off pretty substantial amounts of capital, at least in terms of their loans that they had lent some of these companies. For example, I think one of them was Chase Bank had a $150 million write-off. So, I'm sorry, $150 billion write-off. So it's not like this is a small amount of money. It's for Chase, it is, but in the grand scheme of things, if it's that happening at that level, what else is going on? And I think that's really why we wanted to bring it up and talk about it, because we're seeing some odd ripples within that space that maybe we should at least be looking at to see if there's, where there's smoke, there's fire, so to speak, is really where I'm coming from.
Yeah, and there's a lot of things I think that are concerns here, right? Because you have the fact that you have money that's sort of existing with these. I'm going to call them no defies because that sounds a lot more fun. So we're going to call them no defies, or at least I am. And so these no defies, they've got a lot of money, like tens or hundreds of billions of dollars in play over there. And we don't have FDIC insurance. Now, again, like people on this podcast, longtime fans of this show, okay, right? What does the FDIC really do anyway? It went bankrupt, excuse me, in 2008. So it only insures deposits up to a certain threshold anyway. It can run out of money. There's a lot of negatives, that you could point to with the FDIC system anyway. But the money's not in a bank, it's just kind of out there. But banks are lending money to and participating in, investing in kind of indirectly these sorts of really risky things using the no-Defies. I'm so glad I came up with that. And so it's like it's bad. That's bad news, because you don't know. You don't know what they're invested in. There's not that oversight. Regulatory oversight is a double-edged sword in a lot of ways, right? But as long as we've got this kind of situation where interest rates have been low. I mean, I know people feel like, oh my God, interest rates were really, really high recently. Thank goodness the Fed's been cutting rates, right? But I have to bring this up every time. Like when my parents were home shopping, interest rates were like 18% for a mortgage. Y'all don't know what high interest rates are, right? And so you have this really, really low interest rate environment for a very, very long time. What do banks have to do? They have to look for higher rates of return. Like, I don't know if anybody feels like corporate greed is like in season and out of season, or if it's just all the time. But like corporate greed, right? That's like a thing. And people are looking for money. They look for rates of return. People are trying to make a buck out there, and they're trying to do it with as little risk as possible. So if you can create this very weird kind of systematic smoke and mirrors kind of thing where you go, well, we're not really buying subprime mortgages. We're just giving money to a company to participate in their returns when they make subprime mortgages. Like, I mean, I think I see this every episode, but what are we doing here? It's weird.
So, allow me to play out a timeline here, and I want you guys tell me if it just feels like just the next level. Obviously, we go off the gold standard. The value of money becomes very subjective. We have what's called a fractional reserve banking system. So banks are only required to have so much money in the bank at any point in time. When banks make money is they take money, they give people money in your loans, and then there's like a multiplication effect that has. Now, what ended up happening during COVID is that regulations, to the way I understand it, were loosened to the point of where basically the idea of reserves means almost nothing at this point. Banks can give out as much as they want to a certain degree. Like it's long as the bank functions on paper, you're good. This feels like taking that whole concept of like fractional reserve banking to even like another abstraction where like they're loaning out money to these other places that loan out money or whatever they do, and their own system like functioning the same way the banks do. Like it's the whole thing to me feels like we haven't learned any lessons at any point in time that like not having something stable in here matters, and we keep it's like almost like you keep pouring water into the liquor bottle at your parents' house that you've been sipping on until eventually like it hasn't been liquor in 2 years. It's literally just all water. All the liquor is so diluted, and like that's what's going on with money and like the value of money in our world. Am I off base on that? Because when you said these in diffies or whatever they are the other day, Rob, this is we talk about a lot of stuff on here. This is the first time I really had to scratch my and go, I have no idea what you're talking about with this. Because and the thing is well, you say that the things that these represent are things that I think we all know. I mean, to me, it sounds like you have basically your in-house financing anywhere you go. It would be fall under this umbrella. Now, granted, some other institutions utilize the things that allow that to happen to do other things. But so it's a very common thing that we probably all encounter every day, but don't think about what that actually means in the long term.
Well, there's one particular area, and I know you've got more to say on this too, Rob. But there's one particular thing that like gives me pause more than any of the others because there's a lot of things that count as a no defi, right? Okay, there's a lot of different types of companies that fall under that umbrella, but one of those things is private equity funds, and private equity funds. I happen to do a ton of research on this topic for a different podcast that I was on, and that is some very eyebrow raising, suspect, questionable, other big words for bad. That there's a lot of weird stuff that goes on in that space. Okay. And so what are we talking about with that? That's companies that are like doing deals 80% on debt to buy out a company, fire a bunch of people, restructure, try to invest in technology and flip it. But they actually are doing all kinds of nonsense on top of that. They're paying themselves massive dividends, using additional loans. Like it's financing on top of financing on top of financing. And so it's like, where is the actual money? And I feel like the answer that we have to that question is, I don't know, go ask that guy. And you just kind of like just point the finger. I think the bank gave us the money. Well, then where did the bank get the money? Well, they made it out of thin air, right? And so
There's a TikToker I watch that goes over this stuff all the time. Like he has a video where it's like him talking to himself as like the rich guy talking to the normie guy. And he goes so deep into the weeds about like shell corporations and private equity and how, you know, Ian Carroll had a video on this the other day when he was talking about the whole, what do you call it? In regards to the GameStop situation and the idea that like basically these creations exist that on the super fake money to continue siphoning more wealth towards themselves, bankrupting the company, like not paying anything back because we wrote this is why lawyers can't be in charge, people. I'm sorry. This is why you can't let them anywhere near government because this is what happens. I'm sorry.
you can't if men were angels, you wouldn't dare have a government, right? Like it's just one of those things. It's crazy to think that this would happen. Like the fear is, oh my gosh, we got to regulate the financial sector. I think there's 68 different regulatory agencies. The last I remember getting a number on that. I could be wrong, but it's a very very large number of different agencies that regulate the financial world, quote unquote regulate. It's just a shell game. It's just a whole bunch of
It's the cost of doing
favoritism.
business. That's
Right,
all.
right,
That's all it
exactly,
amounts to. It's the cost of doing business.
exactly. This would not be happening if we actually had private people risking private capital to make things happen. The reason that we have this is because, I mean, it's the legacy of Jekyll Island, right? But it's because we have money that can get created out of thin air. That is not a power that should exist. Nobody should have that. I don't want it to be private. I don't want it to be public. I don't care if the Fed is private or public. That's a subject of debate or whatever. I don't care. It shouldn't be a thing. And the after effects of that, the gradually worsening and worsening and worsening ratios and data and all this stuff on like GDP to debt and etc. It's all because we are playing a stupid game. We are going to win a stupid prize, and it's going to be bigger and worse the longer we play. So that's it. That's my view on this.
To describe what's actually going on here so what's happening, people, is they've created monopoly money, but they're using that monopoly money to buy real assets. Like that property that Bill Gates owns, that's a real asset that he spent very fake money on. But now, legally, it is his. This is always a place where, like, I think people get angry at capitalists. Like, oh, you guys are always sticking up for the bad guys. You're always doing this and you're always doing that. And it's like, well, but I'm not the person that wrote the rules this way. Like, I wouldn't have wrote the rules this way. It's this is not something I value.
Well, I mean, people are always trying to in what we always see is the government's always trying to solve problems that they were the root cause to create in the first place. And that's really what's going on with our money game. Luke, you brought up before, you had mentioned, banks trying to make money on interest rates and so on. One thing to keep in mind that our posthumous Nelson Nash, our mentor, had mentioned was that banks make the most money when interest rates are low. And that what he means by that is on the margin. So what I see in a situation like this, with now all these companies know, the banks know, all these quote unquote greedy people, so to speak, maybe see that interest rates are going to be held artificially low. Well, how do you make more money if rates are low? Well, you can do it a couple of different ways. One is, if I know they're going to be low, how can I increase the volume? If I can dramatically increase my volume without having to increase my reserves, i.e., a bank lending to create capital at an NDFI, now these NDFIs go out and they're using leveraged capital in order to make loans. That's exactly what's going on in this market space. And then you brought up the whole leveraged buyout situation, which for anybody who wants to really understand leveraged buyouts, I highly recommend any of Barry James Dyke's books. Pirates of Manhattan, any of them. They're all good and at really highlighting some of those challenges. But that's what we see these NDFIs are being used for in some cases, not all of them, but some of them. But what I see is it's this big knock-on effect of artificially low interest, people trying to maximize, or banks trying to maximize on that, those low rates and drive the margin up even higher by expanding their reach. And then they do it in an area that's very much or I should say less regulated than some of the others, and doesn't have capital reserve requirements. They have some areas where they have to be mindful of, but like when we say a bank doesn't need reserves in our current state, they still have to have actual like capital reserves in the bank, like that they have, but they don't have to have deposit reserves any longer for the money that they lend. And that's really what we're saying here. So, and in this case with NDFIs, they don't need any of it. They're giving them loans and then they're going and lending off of that. So that's really what's going on. And it's a big shell game, just like you guys were talking about. So that's kind of like the mechanics on what's happening.
Let me add some data to that too, because we're talking high concepts and all that stuff. You can easily find information on how big some of these NDFIs are, things like Visa and that sort of stuff. There's a huge, it's hundreds of billions of dollars, but banks have been investing more and more and more heavily into the NDFI space. And so just in this year, in 2025 to date, there's been a 50% year over year surge in NDFI holdings or loans to them rather. And so, I mean, it's been hot and it's getting hotter. And you have to ask the question, why? Right? Why did we have the 2007, 2008 collapse? Well, it was a systemic issue. All of the banks were participating in these crazy risky investments, et cetera, et cetera. I mean, there's a lot there. You can read Tom Wood's Meltdown. You can read, The Great Deformation. There's lots of wonderful books on this. But, uh, you know, that is one of the key things. And that's what people kind of have in their heads. Oh my gosh, they were buying subprime mortgages, right? Well, so if they're still buying subprime mortgages, among other things that are very risky, and they're doing that faster and faster, and they're just doing it kind of through an intermediary, right? It didn't really solve the problem. We didn't really learn our lesson. All the things we've already said, and they're scaling that up, right? Fifth Third Bank, I was able to find Fifth Third Bank has only about 8% of their holdings are in these NDFIs. Okay, or their loan portfolio. I don't know why I keep saying holdings, but only about 8%. That's low. A lot of these places are 14, 16, or even higher as a percentage of their loan portfolio. And so I don't know about you, but a lot of businesses can't stand a like 20% shock to their profit center, right? If all this starts to come apart, That's going to be bad news. It's going to trigger the, oh my gosh, the financial system is falling apart, sort of a panic that we have seen in the past. And when that happens, I mean, I know we have to turn this into a positive, but a lot of people are going to get hurt real bad. The positive is, if you're watching this episode and you have, and we say this all the time, if you have powder dry, if you have some capital that you control, if you have money in a safe place, and I'm not talking about a bank, I'm talking about an insurance company that you can deploy, that you can touch, that you can invest. I mean, a whole heck of a lot of millionaires were made in 2008, right? You can be one of those. There's ways that you can capitalize on a crisis, and it's only if you're flat-footed and ready to go. Or excuse me, not flat-footed. If you're caught ready to go.
I want to point out before we get too deep. You mentioned earlier we were talking about these cycles of greed, and you mentioned jestfully, these times that people are just extra greedy. The bottom line is greed has nothing to do with it. We have a system that is set up where you have to turn a profit. You have to go and find the highest return you can make because you have a legal obligation to your shareholders to do that. If you don't do that, you're running all kinds of legal liability. The other element being everyone's treating regulation and government like the big hero in the room that's looking out for you. And the most empowering thing that I think we can tell people at this moment is they're not there. Like they have obligations that have nothing to do with you, the average person. In fact, obligations are often very contrary to you because of the way the system is set up. Relying on them to protect you is foolhardy at the best because that's what happened in 2008. Is people were expecting Big Daddy government to be there to protect them and take care of them. When who got bailed out? I don't know how America had not had a bigger reckoning with the fact that they bailed out Wall Street, not Main Street, and even the worst, Republican Reaganite is never going to try and pretend that money was ever going to trickle down. There's no way for it to. There's no protecting Main Street by protecting Wall Street. That slogan, man, whoever came up with it, just woo. So you need the empowering thing is you need to know that this is the world. Greed doesn't wave. You have a system that's set up a certain way. Is educate yourself on the system, educate yourself on how things operate, and know that it's up to you one way or the other. You're the only person. The buck stops with you. You have to take care of yourself.
Yeah, totally. And I think that's a big reason why, having lived through 2008 myself and seeing how things were handled, how it was operated, I wanted to be in a situation where I didn't have to worry about what was happening. And that's a big reason why I'm doing what I'm doing. And that's to serve and help people so that they're insulated and protected in these situations. They don't have to worry about it. Now, maybe some people will be because they want to put their money, still put it to use, but they still have this great level of security to fall back on. And that's a lot about what we structure and what we do for our clients here. But it is an interesting concept, Nick, that you bring up that, there isn't anybody that's going to go out and watch for you and be your advocate. All these companies, all these ABC agencies have these acronyms as if they're going to go do this for you, but they're not. They're not going to do that. It's like we said before, it's there so that it's for these companies that they know the cost of doing business. That's what it is. And they're willing to pay that cost at your expense. And then you're the one who has to pay for it, you and me, through our tax dollars, et cetera. So if we can begin to find ways to operate outside that system, that's what we're doing. And that's what we're helping to secure for our clients and how we work with people and help them so that they don't have to deal with that anymore.
What's really funny to me is that there's only two advantageous positions to be in. One is having a lot of capital to deal with things as they come. In 2008, I was in the other camp. I was homeless, and didn't have anything to lose. There's nothing to be wiped out for me. That's never a good situation, even in that situation, folks. So learn what you can, be prepared. Find the capital, talk to guys like Luke and Rob here and help you be in the position that we're all in now, where we have options. Like I'm in some ways glad that I didn't have anything to lose, but if I'd known all this then, I could have been in even a better position then than better position now.
Sure. But I mean, it's the whole second best time to plant a tree thing. I mean, it's the literal best example to use on this. But you you get to make a choice, right? Every day, every time we release a podcast, every time we put this message out there, anybody watching, anybody who hears this for the first time potentially, you get to make a choice every day whether you're going to take responsibility for your financial life or not, right? You can just go, the FDIC's got my back, right? But and I'm not going to get into the weeds on this, but look up the Dodd-Frank Act, right? Bail-ins. What is on the books legally now is bail-ins. If we have a financial crisis and all your money's in the bank and you're just waiting for the FDIC to hand you a check, guess what? It's not going to happen. They're not going to use a taxpayer bailout the next time this occurs. That has been on the books for a long time now. What is going to happen is they're going to use customer deposits, AKA your money, to recapitalize the bank. They're going to take your money. That's what the law is. And so, if that's a better scenario for you for some crazy reason, go for it. But I mean, that's not what I'm going to do. I don't want my money anywhere near a bank more than I need to do my day to day operations, right? So, yeah, it's worth doing some research. So we've got an incredible toolkit for you. If you are still here with us, you obviously been taking this very, very seriously. You care about the future of your money, right? So we've got a toolkit that's going to help you demystify the future of your money. It's got a copy of my Amazon best-selling book. It's got 2 free video courses to help you understand our investment and savings strategies that we use. And you can get all that for free. It's at perfectspiralcapital.com/podcast. Sign up there, get a free copy of the toolkit today. Thanks so much for watching. We'll see you in the next episode.